Canada's housing market is finally cracking. Here's what that means for you. 22%. That is how far Canadian home prices have fallen from their 2022 peak. Not in a distant financial crisis. Right now, in 2026. For years you were told the same thing. Too much demand. Not enough supply. Canadian real estate only goes up. Nobody told you it would crack quietly, while most Canadians were still debating whether to buy. Today, I'm going to show you exactly what the data says is happening, why it hasn't felt like the crash everyone predicted, and what it means for your situation, depending on whether you're renting, own a home, or gave up on buying entirely. Because the right answer for each of those three groups is completely different. Stay with me. The real data. What is actually happening? In early 2022, the average Canadian home peaked at $841,900. Today, it sits at $652,941. That's a decline of roughly $190,000, 22%, in less than 4 years. National average, January 2026, $652,941, 22% below the 2022 peak, down 2.6% year over year. See REA. But the national number hides what's really happening city by city. In Toronto, the average home fell to $973,000 in January, down 6.5% year over year. That is the first time since 2021 the GTA average has been below $1 million. Even more alarming, Toronto's new condo sales in 2025 hit just 1,599 units, the lowest since 1991, down 91% from the decade average. The pre-construction market is in genuine distress. Toronto new condo sales, 2025, 1,599 units, lowest since 1991, down 91% from decade average. CMHC. And nationally, the benchmark price has fallen for 8 consecutive months. Not a blip. 8 months in a row. So why does it feel different from the crash people were expecting? 2 reasons, and both of them matter for what you do next. Why it's declining but not collapsing. A true crash requires distressed selling. People with no choice but to dump their homes at whatever the market will bear. That isn't happening at scale yet. Most Canadian homeowners have equity built up over a decade of appreciation. They can afford to wait. And they are waiting. Low forced selling means controlled inventory. Controlled inventory slows the decline. But the forces pushing prices down are real and they're building. First, the rate shock aftermath. Even with the Bank of Canada cutting rates to 2.75%, the buyers who stretched themselves at peak prices are now quietly listing. It's starting. Second, the immigration slowdown. The bull case for Canadian housing was always population growth. That story has materially changed. CMHC is now projecting near-zero population growth in 2026. The demand engine that kept prices elevated has been throttled. Third, tariff risk. The uncertainty hanging over the Canadian economy from U.S. trade policy is unresolved. CMHC is projecting GDP growth of just 0.7% this year, one of the weakest years in recent decades outside of an outright recession. The result? A slow grind down, not a collapse, not a recovery, a market repricing towards something more sustainable city by city, at very different speeds. What this means for you: 3 situations. The same housing data means something completely different depending on your situation. Let me be direct with each group. Group 1. You're a renter waiting to buy. The affordability math is improving for the first time in years. RBC Economics. Projects that monthly mortgage carrying costs will fall in 2026 in Toronto for the first time since 2020. Prices are lower. Rates are lower than their peak. That combination hasn't existed since before the pandemic frenzy. But here's what I won't tell you, that housing is cheap. It isn't. If you earn under $120,000 household income in Toronto or Vancouver, home ownership in those cities remains financially marginal even at today's prices. If you're in Calgary, Edmonton, Quebec City, Halifax, or virtually anywhere outside the 2 major metros, the picture is dramatically different. Run your own numbers for your specific market. The national headline doesn't apply to you. For renters, affordability is improving, but run your own math. Compare total monthly ownership cost to rent, plus investing the difference. That number is more useful than any prediction. Group 2. You're a current homeowner. If you bought before 2019, You still have equity even after the 22% national decline from peak. You're fine, as long as you're not forced to sell. The danger zone is buyers from 2021 and early 2022 who bought at or near peak with a small down payment and are now facing mortgage renewal at meaningfully higher rates. If that's you, your renewal conversation this year is the most important financial decision you're making. Don't let your bank auto-renew you without shopping rates first. For everyone else, your home is shelter. If you're staying for 10 or more years, the 2026 valuation is almost irrelevant to your long-term picture. What matters is that you're not treating unrealized paper equity as spending money. That equity is not as permanent as the last decade suggested. Group 3. You gave up on buying and pivoted to renting. This group gets ignored in almost every housing video. So let me speak directly to you. If you decided the math didn't work and chose to rent and invest instead, the data validates that decision. The S&P 500 returned significantly more over the last 3 years than GTA real estate. Renting and investing the difference is a legitimate wealth-building strategy, not a consolation prize. But the math only works if you actually invested the difference, not spent it. Toronto. Monthly gap. Renting versus owning a condo. 2026 estimate. Average one-bedroom condo rent. $2,200 per month. All-in ownership cost. Same unit. Mortgage. $550,000 times 4.9% times 25 years. $3,150. Condo fees. $650. Property tax. $350. Total, $4,150 per month. Monthly gap, $1,950. $1,950 per month invested in TFSA at 8% for 25 years equals $1,730,000. The math works, but only if you're actually investing it. If the honest answer is that you've been renting and spending the difference, that's your action item today. Open a TFSA. Set up an automatic transfer for the gap amount. That single move is worth more than buying a house at almost any price point in Toronto right now. Where does this market go? From here, I want to be direct about what we can and can't know. The most likely scenario, which is what CMHC, RBC, and TD Economics all project, is a continued slow grind lower through 2026, followed by a tentative recovery beginning in 2027 as pent-up demand from first-time buyers starts to clear inventory. The tail risk nobody is advertising loudly. If Canada slides into a recession, and at 0.7% GDP growth, we're already close to the line. Forced selling accelerates, and the slow grind becomes something faster. That's not the base case, but it's not zero probability either. The wild card is U.S. trade policy. Tariff escalation hits Canadian employment faster than almost any other factor, and employment is what ultimately determines whether homeowners are forced to sell. What I take from all of this is not doom. It's just clarity. The era of Canadian real estate only goes up is over. The market is repricing towards something sustainable. For Canadians who understand that, this is a map, not a crisis. The close. We started with a number, 22% below peak. 8 months of consecutive decline. Toronto below $1 million for the first time since 2021. Condo sales at a 30-year low. This is not the crash everyone pictured. It's something more useful. A slow repricing that creates real opportunity for the people who understand it and real risk for the people who don't. Here's your one action. Figure out which of the 3 groups you're in and make sure your financial strategy matches that reality. Not the market your parents navigated, the one you're actually in.